As you all know, the income and wealth gap in the United States is enormous and continues to grow. While on average consumers are doing better now than they were 10 years ago, most of the benefits of the growth have gone to the top 1%, and many Americans are struggling to set aside any types of savings and deal with day-to-day financial challenges. The Center for Financial Services Innovation, or CFSI, has spent a lot of time analyzing the true financial state of consumers in the U.S., and they've come up with some basic concepts that I think are helpful as context for what we're going to talk about tonight. So, CFSI has defined consumer financial health, or when you're financially healthy, in four categories. One, the category of spend, is when you spend less than your income. Seems obvious, but about 40% of the population last year spent more than their income. Second is when you can pay your bills on time and in full. For savings, you have to have sufficient living expenses in liquid savings to handle several months of no income, and have sufficient long-term savings and assets to deal with retirement and later in life. In terms of borrowing, you have to have a sustainable debt load and a prime credit score, and you have to have some kind of appropriate insurance and the ability to plan ahead for expenses. Now all this seems pretty obvious to this audience, but as I mentioned, 47% of Americans are spending more than their income today. 36% are unable to pay all their bills on time. 45% of Americans don't have enough savings to cover 3 months of living expenses, and 37% of Americans are not on track to meet their long-term financial goals. A third of Americans say they have more debt than they can manage. A little less than that don't have a prime credit score. More than a third are not confident about their insurance coverage, and 40% of Americans don't plan ahead financially. There's some reasons for this tied to generational issues, because if you struggled financially growing up, it's more likely that you're struggling today. But cost of living has clearly increased a great deal more than income. Wages have really gone up only about 10% on average since 1973, while housing, food, and other healthcare costs have doubled or tripled that. Just think of your tuition. And millions of Americans are struggling to deal with the basic necessities. One particular issue that's really become significant in recent years is instability, both of income flows and of expenses. Expenses have always been somewhat variable, but with so many people living close to the edge, things like a single large medical copay or a not getting an expected bonus when you're a retail worker at Walmart can make a significant difference and force you into debt and other unattractive methods of trying to deal with your financial challenges. So with that as background, all of us here at the Richman Center are excited to hear from this great panel and hear how these different companies are working to improve financial health while building startups in the fintech environment. So I'm going to start the ball rolling by asking Jeff Kaiser from Propel. Jeff is to my left here. Propel's done an amazing job in providing fintech-based services to a completely unserved segment of the population, those people receiving food stamps. So my question for Jeff is, how did Propel and you come to the conclusion that this was a part of the population worth serving, and how is Propel thinking more broadly about serving these customers?
Thank you. Thanks, Todd, and thank you to the Richman Center for having us. It's a pleasure to be here, and I'm excited to tell you guys a little more about what Propel does, where we are today, and where we are going in the future. I think to answer your question, we started to believe that Americans who receive food stamps are a valuable customer segment for a few reasons. One is that they're people and they're customers and they're buying things. Two is that they were drastically underserved in a bunch of different ways, specifically when it comes to their benefits and actually technology around managing your benefits and what the user experience of being on government benefits is like today. And then the third is like purely a market size question or realization, which is that there are 40 million Americans who get food stamps. They spend $70 billion a year through the EBT card, and that for those of you in business school, that's a decent market. So that for us was enough to say, nobody else is really looking at this population. Let's see if we can find ways to use good consumer technology to solve real problems. Early on, we spent a lot of time in grocery stores talking to people as they got ready to spend their food stamps. And so we learned about the behaviors and the habits and the pain points and the challenges that come from spending the funds on this card. So the EBT card is a closed loop debit card system, which means you can't put money onto it and you can only spend it in certain places. And the way that consumers would know how much money was on their card was by calling the 1-800 number on the back of the card. Every time they walked into a grocery store, these are mostly low-income moms buying groceries for their household.
So they had no way of knowing how much was available and how much they spent.
They would either call the 1-800 number every time they walked into the store and try to remember that number so that they didn't go over it by the time they got to checkout. They would carry grocery receipts, so the balance is printed on the bottom of the receipt. Or my favorite is people would buy the cheapest item at the register, like a banana often, to check the balance and get that receipt in real time before actually making the rest of their purchase. Which seemed totally insane to us in a world where all of those people were carrying around smartphones and probably using another app on that phone to manage some other financial product, which I'll come back to in a second. So we built what was effectively a mobile banking app for the EBT card. And we saw that we didn't have to invent a new habit here. People already needed to check their EBT balance, and giving somebody a slightly easier, more frictionless way of doing that was pretty sticky. So in the last few years, we've grown to over 2 million monthly active users. So that's about 10% of households. So there are 40 million people and about 20 million households across the country who have that card. And people use the app on average of about 10 times per month, which roughly correlates to 1 time per shopping trip. So people are using this consistently as they go into the store. I think we approach this from a financial health perspective because this is ultimately a financial product. People don't always talk about it as such, so people refer to the benefits or my food stamps, or this is for my food, and it's sort of distinct from my money. But when you start to dig into that a little bit, it's pretty clear that this is an important part of a household's purchasing power for a lot of the people that we serve. And that they think about, how to balance the spending with their food stamps with needing to keep a little bit of extra cash available. Food stamps for most households do not last the full month. They don't cover the full food needs for a household. And we were seeing kind of a lot of the same behaviors that you hear about that Todd was describing from the CFSI study on not necessarily always the most economically rational behaviors when it comes to how people were spending their benefits. Now, none of us are economically rational purely, but the system is not designed for success. So when you get a monthly lump sum deposit, people are much more inclined, and this goes for people with paydays as well, you're much more inclined to spend more when you feel like you've just made a lot of money. And then at the end of the month, you may have very little left. And actually have a harder time feeding your family in those days. And we actually saw this, and there's been a bunch of studies that have shown higher admissions to hospitals for hypoglycemia at the end of the month, lower student test scores, behavioral problems in schools, because basically people aren't eating enough at the end of the month. We worked with the Common Sense Lab, which is a Duke-affiliated behavioral economics research group, to test a bunch of different interventions to see if we could do small things. We don't want to tell people how they should spend their benefits, but are there little nudges or little ways that we can show people, that there might be easier ways to try to get their benefits to last a little longer. The one that worked was really simple. So in addition to displaying the full monthly benefit amount on your current balance, we show underneath that a recommended weekly budget, which is simply the amount you got divided by 4, and anchoring people on this concept of this is roughly how much you have each week. We saw basically add an extra day of slack. So if you were normally spending your benefits within the first 10 days, which was about what we saw, you got an extra day of benefits out of that just by seeing and anchoring on this idea of a weekly spending amount. And I think we are excited about continuing to do test those types of interventions. Actually, during the government shutdown, there were a bunch of changes to benefits, which I won't go into too much detail on. There's been a bunch written about, but we built a little savings tool in a sort of crisis mode. We shipped it over a weekend and allowed people who were getting early benefits because of the shutdown to actually kind of like stash some benefits away for later in the month when they might have otherwise run out. And we had about 40,000 people use that feature. We don't have results from if it worked yet, but people were certainly really excited about that. Am I over my?
No. So why don't you tell us a little bit? How are you going to make money?
Yeah.
And how then are you going to expand? Because you've got you more than anyone else probably have this demographic pretty well corralled.
Yeah, so today we make money from advertising and referrals. So we sell ads to mission-aligned products and services that want to offer our users ways to save money or earn income. So we have a job board, we have a couponing feature, and we get paid in most of those cases on a success basis. So when somebody applies for a job, or when they clip a coupon, or they enroll in a matched savings program, we get paid from a series of partners. We are starting to look more into kind of the non-EBT portion of our users' finances, and have just over the years learned a lot about a lot of the financial habits and behaviors of these households. And we're talking about households with very, very little money. So looking at $10,000 to $20,000 a year annual income for those who have any income. And there are not a lot of products that are serving that demographic well. Our users rely heavily on high-fee prepaid cards, on check cashing services, on payday loans. I took the opportunity of coming this far north. I live and work in Brooklyn to meet with a user. We do a lot of user interviews, and so I met with somebody who uses our product in Harlem, and she uses a prepaid card from a check cashing store, and the payment model is per swipe. So every time she swipes her card, she pays a $2 fee, and she pays to put that money on the card in the first place.
If you were to translate that into an APR or something, it would be astronomical.
Yeah.
That's the most expensive type of abusive prepaid card you can think of.
Yeah. So, and there are better products out there for her. She could use Chime,
right.
But they're not looking for her, and they're not reaching her successfully. And we could through our platform. So our hope is that we can build a product that has a really low acquisition cost because we have this audience, and build a product that does not try to make money in that way, and that serves people really well, and that helps them build good financial habits.
Good. Let me turn now to Ariana. Ariana, you were involved in the founding of Square Capital, which was one of the most interesting small business finance solutions of recent years. And now you're at Petal, a relatively new company, which offers people with no credit history or a limited one, helps them build credit through a new type of low-cost credit card. So what is the concept of the Petal card, and who is it focused on helping?
Great. Thank you for having me here tonight. So I'll give you guys a bit of an overview on the Petal card. The Petal card is basically a new credit card, and our goal is to really serve folks who have just been underserved by the credit system. We don't require a FICO score to get approved for the card.
And nobody else really does that, do they?
Nobody else really does that right now. There's 90 million Americans who are misscored in the system. There's tens of millions of Americans and immigrants who just are invisible, completely invisible in the credit system. And today, being invisible means being subprime. And so you kind of have to start from the bottom and sort of work yourself up in this really bizarre system, in this bizarre broken system. So
meaning that you might not be subprime in terms of your actual propensity to repay your credit, but you're treated as it because you don't have a score.
Exactly, because longevity of your credit history matters so much that you could be, 30 years old, have a great job, have a great personal balance sheet, but as far as the credit system's concerned, you don't exist, and if you don't exist, you need to start from the bottom, and you need to often get a secured card. So you give a credit card company $500, and then they give you the privilege of spending that $500. And you do that for a while with interest and a fee. So it's really sort of this broken part of the system, and the way Petal. I think there's really three different main aspects of our business. The first is really that cash flow underwriting piece. So in the application process, folks will give us access to their bank account data using the aggregators out there today, and we really make sense of that data. We can see your direct deposits, we can see your rent payments, we can categorize your spend, we can see that. How your spend trends and how your income and your expenses, to your point, these things have become a lot more volatile in recent years. We can sort of really make sense of that data. If you have any history in the credit system, we can use that as well. If you don't, that's fine. And so that's sort of the application process. And then we really give people a fair credit product. Our lines range from $500 to $10,000. Our APRs range from about 15 to 25%. And normally intro cards really start around 25%. And we don't charge any fees. We don't charge any late fees or annual fees as well. So that's really the kind of core of the market that we're addressing. I think the second sort of thing about Petal that we're really focused on is it's an exciting opportunity to build a credit card experience from the ground up. We're taking a really digitally native approach to that. So we're saying there's a lot of things that don't really make a lot of sense about credit cards if you think about it, and we're trying to take an opportunity to rethink that. And so I think that's where we get a lot of exciting opportunities to think about these financial health. We take a kind of a financial health approach to it and think about behavioral nudges. Think about how do we sort of make this tool something that actually really works for people and doesn't necessarily just sort of kind of consume
Right, because the
fees.
tool itself is pretty flexible.
Right.
The tendency in the industry has been to encourage the least financially healthy behavior, the minimum payment, and letting the balances go up and whatnot. So is Petal thinking about how to give people more flexibility around the payment terms and how to help people not get into that situation where they build up too much debt?
Yeah, absolutely. We're early on in our days, but we're really excited about our opportunity to sort of test all these different hypotheses. So right now on our payments page, if you're a Petal card user and you go to make a payment, we show you in dollar cost what the interest associated with that payment is. So we always default people to the full amount. We have a slider. We've experimented with some sort of visual representations of cost of credit. So we always sort of default you to the full amount, and if you sort of drag that slider to the left and make a smaller payment, because you need to use that revolve tool, we show you in dollars on your next statement how much interest you will pay. I think the APR, certainly at Square Capital, we learned this, and again at Petal, it is just not something that makes any sense.
That's one of the for the lawyers in the room, the whole structure of disclosure and control around consumer credit is tied to the concept that if we can have one interest rate, an APR, which reflects the actual cost, people will change their behavior based on that. And what we found in reality is people respond much more concretely to dollars and to things like this toggle bar, and how that works, where you move it down and show up or down to see how much you're going to pay. That creates a much deeper internal understanding of what you're doing rather than just defaulting to the minimum payment alternative. Another interesting thing about Petal is a good example of the revival of what you call cash flow underwriting. So Petal's using bank data to look at the ins and outs of a person's financial experience and then derive a credit expectation from that. The interesting thing about that is that's the way credit was always done back in the day before some clever person invented credit scoring. But the banks always said that it was too expensive to do cash flow underwriting because somebody had to look at the actual experience. What technology has done is allowed that to be automated. Yeah. So is that kind of what you're up to, and do you view that as sort of the core of how you can underwrite people who the traditional system can't?
Yeah, that's exactly right. I think we view the score as sort of a bad, incomplete, and very slow proxy for the underlying financial data. And if you can just get straight to that data, you can actually get a much better sense of what's going on in somebody's financial life. And I think that part of that is that it's continuous real-time data too. So we can actually kind of track how somebody's finances actually change. We can see raises, we can see different income profiles, and as those things change much more frequently these days, that becomes an increasingly important part of the credit modeling.
Have you had any issue with the banks that serve your customer base in terms of getting the data and cooperation with the aggregators so that you can get the information necessary to do this type of cash flow underwriting?
Yeah, it's a good question. Short answer is with some banks, yes, for sure. I think it's really interesting. It's very topical. A topical issue these days where, for example, I think Quovo and Plaid both publicly have an issue with TD Bank right now that's sort of been an ongoing tiff. And basically, that creates an issue for us because we rely on those aggregators. But the customers now are sort of advocating for it because the customers ultimately are interested in using these financial services. And if they don't have access to them because their bank's not cooperating, they are now kind of speaking out about it. So it's kind of an interesting time to be in the middle of that.
And in Europe, the regulatory regime that was adopted a year or so ago really forces the banks to cooperate and provide data in the appropriate form, or at least theoretically does. And in the U.S., we're struggling with this question. And so is Petal involved in advocacy efforts around data availability and data security?
Yes, we are. We are involved in that. I mean, we believe very strongly that consumers should own that data. I think, to your point, often banks, if you think about it, Chase Bank has checking accounts, Chase Bank has credit cards for a lot of different political and organizational and incentive reasons. Those products that use that data aren't really coming to market from those big banks. So it's really important that customers sort of have ownership of that so they can access the products that they deserve.
Thanks, Ariana. Majd, your product, Status Money, is focused on using behavioral and economic psychology essentially to improve outcomes for customers, notably by offering customers a way to compare how they're doing with similarly situated anonymous peers. How does that work, and what's your vision for where that concept can take your company?
Sure. Hey, Todd. Thanks for having us. I'll tell you, we started Status Money with the idea that if you give people information, they will be better off. And we don't lend money. We don't give advice. We simply provide information. And that information is a benchmark. So what we did is we worked with a number of companies to aggregate information from millions and millions of people anonymously around the country. And when somebody creates an account with Status Money, we use their profile to show them how their finances compare to people of a similar age, with a similar income, who live in their city, who have a similar credit score, as flawed as that may be. It is still important for most people to understand what their credit score actually is. And using that information, we reveal to people whether or not they are spending more than people who are similar to them, or perhaps carrying too much debt, or interestingly, paying a higher interest rate on a credit card or a mortgage than perhaps they should be. It is transparency of information. And this information, obviously, was not really available. It's not a mystery that speaking about money and talking kind of personally and sharing information, private information, is uncomfortable. So we don't do it. So I don't go around asking people what the mortgage rate on their interest rate is and what their credit score is. But it actually makes for an interesting conversation. And when you do it at scale, it creates change. So we did some work with behavioral economists at the University of Chicago. And what they found out is people using our platform, when they see their spending exceed that of their peers, they correct course to the tune of 23%. They reduce their spending 23%. That's massive. And anybody who's touching consumer behavior knows that that's the holy grail. Changing consumer behavior is very, very difficult. And what we basically did is figure out a hack using behavioral psychology to get people to behave in a more responsible way financially. And that was our first step. So that was Status Money 1.0. What we launched just last December was a cash rewards feature. And what this does is essentially reverse the economics between consumers and, in many cases, their banks. So if I was just to say a word about where I think the innovation happened within our business, it really is around the business model. We're a free platform, and we wanted to always be a free platform. And that is a very difficult thing to do in the consumer world. And I'm happy to tell you about how VCs feel about that. But I'll tell you that for us, we came out of the banking world. Both my co-founder and I spent many years at Citibank and him Goldman after that. And all we wanted to do is figure out a way to just reverse those economics. So as of December, we actually pay our members. And they can earn cash rewards, not just for referrals and doing things that I think are now more commonplace, but for opening up a savings account. Earlier this month, or last month now, there was a bank that would pay you $100 to open up a savings account. And by the way, that bank had one of the best savings rate interest rates in the country, 2.45%, which is not much, but it was one of the highest ones in the country. They will pay you to take that action. We had another bank that was offering a $100 reward for people who opened up a credit card. We now have over 50 advertisers, banks mostly, who will pay you to take a financially responsible decision. So that's what we're up to. And the way that I see it, there's no reason why this model only should live within financial services. Anytime there is a company that is interacting with you, and in some cases using your data to provide you with a targeted and personalized message, I think you should get paid for that. So I'm going to go, one step beyond consumers should own their data. I think consumers should get paid for their data. Whenever a company uses information about you to decide whether or not to underwrite you or to market to you or to serve you with an ad, I think you should get paid.
So that's in many ways the holy grail of one strand of fintech thought. I'll just challenge you slightly by mentioning that one of the challenges with data is that my data is a lot more valuable than your data, because so data reflects the income and wealth distribution that we have in the country. So one of the challenges is if we went to a data payment metric, I'm likely to be the beneficiary of that, right? And so, while yes, it would also help people at the lower end, it would be relative to their situation. But it's interesting. So the new offers come in, but they come in the context of the comparative metric, which says this is a good rate, or these are overall good terms, or I shouldn't take any more debt because I've already exceeded my cohort average. Is that how you think about it?
Right. I mean, honestly, for me, being a first-time founder, what I wanted to do is build a company that would be a reason for me to wake up in the morning. And I didn't want to wake up in the morning thinking about all the fees I was charging people, or all those ads that people are going to be consuming. So it was really about how do you do something even after I'm no longer at the helm, and how do you create a system that just works the way it should. And the peer comparison aspect actually is that kind of internal regulatory system. The example is if there's a lender that wants to give you an auto loan. Okay, let's say you can see now with our data that people with a similar income to you, similar credit score, living in your city, those folks pay somewhere between 5 and 8% in terms of an interest rate on an auto loan. If this company is offering you a 12% interest rate, they're immediately disqualified, right? So we don't have to police the system aside from just saying, hey, here is the data. It is all available to you. Now you can make an informed decision.
Mm-hmm. Thanks, Majd. So we'll turn over to Bridget, which is incidentally got the same name as my younger daughter. So I feel very sentimental towards Shuo. So Bridget is a relatively new company that attacks one of the core issues for low-income working people, which is getting small amounts of cash to deal with income and expense volatility without taking on ruinously expensive payday loans or paying, $90 for some overdrafts one day. This is something banks have said couldn't be done for years. I mean, the payday folks who are reversing the CFPB rule on this will tell you that it's necessary to charge as much as they charge in order to provide a service like this. So how is Bridget changing the way that this is working?
Thanks, Todd. So in order to answer that question, I have to first paint sort of a backdrop of how we got here today. So if you go back about 10 years during the financial crisis, hundreds of billions of dollars of credit went away from the system, and mostly for what we would consider subprime or non-prime consumers. Now, for people that generally would have taken out credit in the form of applying for credit cards, they chose not to, either because all of a sudden they lost access to that credit, or they decided that it's the fiscally responsible thing to do to not do so around that time. Right. Now, fast forward 10 years, you've got 63% of millennials that don't have credit cards. A lot of people within the millennial age group would be considered thin file or no file. This is harking back to Ariana's conversation about the FICO score. They never had a chance to really build out their FICO history, their credit history, mostly due to the fact that in the credit system, there's sort of a paradoxical situation where you have to borrow credit in order to show that you can borrow credit. Right. Now, in the place of traditional credit access, what has come to take that place for these users is overdrafts as well as payday loans. For those of you that don't know what an overdraft is, here's how an overdraft works. Right. Let's say you've got $2 in your bank account today. You go across the street to Starbucks right here and buy a coffee for $3. All of a sudden, you're negative $1, but just for that transaction, the bank would charge you $35 in fees, right? Now, we're gonna slam on prepaid cards for $2 per transaction, but $35 per transaction is just heinous at this point, right? And now, that ends up generating, at this point, is a $36 billion fee pool for the retail banks, right? When we started Bridget, we had the fortunate situation of being able to analyze about 4 billion transactions of real consumers and analyzing what is actually going on when people are overdrafting. And so here's what we notice. When people are overdrafting, they're generally going negative by about $100 to $150, paying it back in full in 3 days, and then tacking on $70 in fees just to the bank, right? You can imagine if you try to calculate out an APR for that, first of all, APR isn't really relevant here, but if you really thought about it, that's astronomical. It's 5,000 something % APR, which is just ridiculous.
You're effectively borrowing money when you do that.
Yeah, you're going negative by however much you need to cover your transactions for. Your bank will float you the money, allow those transactions to go through, and at some point in the future, you deposit money back into your account and replenish it back above zero, right? Of course, minusing the overdraft fees that came in during that process. Now, payday loans are not much better than that, but they're slightly better. You'll see a lot of media skits on why payday loans are considered evil. There's a lot of kind of weird practices within the industry. They charge a bunch of huge fees and roll over consumers just to make sure that they can keep generating that fee revenue, right? But you might be thinking to yourself, well, why do consumers do this, right? Why do they subject themselves to effectively what is financial torture at this point? Here's why. As Todd mentioned earlier, most Americans are living paycheck to paycheck, right? It's an unfortunate truth, but the other unfortunate truth of that is that when you are living on the edge like that, there are many times where your expenses just overwhelm your last paycheck and you have what we call a timing mismatch. For example, you make $2,000 a month, but it's paid out in bi-weekly segments of $1,000 each. You just got your last paycheck, but now your rent is $1,200 and you have to pay that in a lump sum. All of a sudden, you've wiped out your last paycheck and you can't really stretch until the next one comes in, right? So users, you can imagine, are extremely financially stressed. Todd has written about this, calling it financial shock, which is really effectively what it is. People find out that I'm going to hit the red. I'm going to be negative pretty soon within that bank account, and they freak out. They need some sort of solution, and they need it fast. Now, you can slam on overdrafts and payday loans as predatory practices, but you can't deny that they are convenient, right? In the situation that I described earlier, where you just swipe a credit card and get your transaction covered, that's the most convenient form of a loan that you can possibly imagine, right? That's it. This is the action. That's all you had to do just to get a loan. You didn't have to fill out a traditional application. You didn't have to give your social security number. I didn't have to look at a 50-page application number, give out all of my information, my address, my phone number, my first child's middle name, just to get some cash, right? So what you have here is the most convenient form of loan, targeting what is really a financial sort of mental health for this user. They want to get rid of this sort of stress. Bridget set out to recreate that sort of same convenience without having to extort users for fees. We also do the same sort of cash flow underwriting for our users. One of our fundamental beliefs and mantras is that the credit system, especially the FICO score, is too static of a mechanism, right? You can't use the same score that you evaluate whether or not I want to give a huge loan for a house versus a medium-sized loan for a car to the same metric that you might evaluate, oh, should I give this person $200 just to make sure they make it to their next paycheck, right? We connect with the user's existing checking account, look at their look at their transaction behavior and underwrite them based on that. So as an example case, let's say we have a user named Victor. He comes in, signs up on the Bridget app, and logs in through his bank account. Within about 20 seconds, we're getting 2 years of history for Victor. And here's what we know about Victor. Victor makes about $40,000 a year. He gets it paid out pretty regularly. Let's call it semi-monthly on the 1st and the 15th. We also know that after every paycheck, he's not blowing it out a round of drinks for his friends or buying an $800 TV every month. But instead, he spends most of his money on responsible things: his rent, his utilities, his groceries, his phone bill, things like that. Everything that you need to live your daily life. With this information, we also know that Victor is dipping negative roughly about $200 every time he has this sort of timing mismatch during his paydays. With that information, we can provide a way better service for Victor than him relying on overdrafts. Each time he's relied on an overdraft, he's transacted maybe 2 times and paid about $70 just for those events. Over the course of the year, he's racked up about $1,100 in fees just over the course of that year, right?
So think about that, $40,000 income, $1,100 in fees. That's not unusual.
That's an entire paycheck of biweekly income just going away to servicing those fees. Right? We can do better. What we're going to do is say, we're going to monitor your account, Victor, in real time. Every time we notice that your balance is dipping close to negative, we're going to automatically float you $200 to $250 just to pad your account, right? Make sure you don't get into the negative territory, hit the red, and get hit by an overdraft fee. Upon your next paycheck, when it comes in, we'll automatically take back whatever we lent to you. Instead of charging a fee per transaction, we simply charge a subscription fee per month of $10. $10. As you can imagine, over the course of a year, using our model, he only needs to pay $120 in fees as compared to $1,100 in overdraft fees.
Do you guarantee that he won't have an overdraft, or how do you deal with that?
We do not guarantee that they won't overdraft. However, for most users, they are extremely aware of how short they are going to be. We lend them just the right amount of money, and they are extremely careful what they do with it. So, going back to the financial health, a big part of what we solve for is making sure that users can live their daily lives without this sort of stress. Victor, in any other situation, would have been extremely cash-strapped about 3 days before his paycheck. He's nervous. He knows he has groceries coming in. He knows he needs to pay his T-Mobile bill. We're going to cover him for that, just so he doesn't have to experience that stress again.
So how's the reception been for the product and the subscription model?
Yeah, so we launched last year around June publicly on the App Store as well as Play Store. Today, we have about 60,000, roughly 60 to 70,000 users that are paying subscribers of the product.